The market is supposed to estimate the value of owning, but the value of the owning depends on the people's perception of what they are selling it for. Professional skill says today leave might be high relative to history. Be points out, but how do we know that the history doesn't change? Except from the brief period, those late 2008 to early 2009, US stock has ever traded above their long-term average cap every month since the late of 1988. If you wanted the stocks to become cheap again by the longest historical standard, before you bought them, you should still be waiting more than one third of the century later. When short stocks that already seem overvalued can even more expensive and stay that way for an belated long time, says Graham. Anybody who tries to reach an information and critical judgment of the current market level faces extreme difficulties. The simplest rule of thumb to estimate the future long term return on stock, you can use Gordon equation. DV, devised in the late 1950s by the economic Myron Gordon. The formula assumes that the market price depends on the income. The market price depends on the growth of the stocks can produce. The stocks market future performance should approximate its a current dividend yield plus average rate in which dividend grows. In early 2004, the dividend yield of S&P is 1.4% over the previous half century. Dividends grows 2.2% annually on average. The adjusted in for inflation, add to those two numbers and you get 3.6%. This is an imprecise but plausible estimate that the average annual return of stocks after inflation over a coming decades, while it is lower than the long-term historical average, it is likely to enable a patient investor to reach their goals. For the discussion, William G. Burston, The Four Pillars of Investing, MC Grohel 2024. Stock for the long run. Beginning of the 1990s, the investors' mind were infected with the new belief stock aren't risky. 2010, a survey for more than 2,200 investors found that 31% believe that stocks always be better than safe investment, like cash and bonds over a period of 5 years or more. The notion is nonsense. It is distorted history and misinterprets what risk means. Let's take the history first. In the book Stock for a Long Run, first published in 1994, financial professor Jeremy Siegel argued that the risk in stocks are less than they found in bonds or even US treasury bills. He based his argument on the data going back in 1802, suggesting that US stocks had outperformed both hands and cash over naturally every period for 20 years or more and had never lost money after inflation over such a long period. That argument has at least three crucial laws inaccurate. Correcting from the survivorship basis. You see the sidebar. The business professor Edward McQuarrie has adjusted the historical records and found that stocks underperformed bond in the US for the most of the 19th century. Bond beat stocks in one third of the 20th period since 1784, not less than one tenth of those parents. As Siegel claimed, as several other major markets around the world, bonds has outperformed stocks for decades in capability. In the past, brokerage commission management fees were at least 10 times higher, and the market tracking index fund doesn't exist. And diversification was costly and cumbersome, making stock riskier than they are now. The investor had to compensated for the risk in form of higher return. Now the diversification is easy and cheap and stocks are less risky, so the future returns is likely to be lower. Impracticability. Historical rate of return has shown that the investors took the income from the dividend and plowed it back into more shares, generating growth on top of growth. Until 1970s, though investors rarely used the dividend to buy more stocks, instead many took dividends as cash which they saved or spent. It doesn't grow from being reinvested in the stock market. Survivor. Imagine visiting a nursing home for retiring lumberjacks and being struck by how old they are. You should conclude that the average worker in the logging industry lives to ripe old age. What you should realize instead in the logging in one of the world's most dangerous occupation and that you saw only extreme outlines. The old and rare surveyors are not a broad and typical sample. Your first impression was misleading because you encountered no trace of many loggers who tragically died in describing survivorship bias, which outweigh the history winners by outlook in the losers. It warms our perceptions of statistical evidence by painting an unrepresentative picture. It is like a rear view mirror made of rose colored glass. In 19th century US, entire industries such as wooden turnpikes and whale oil, steamboats, stagecoaches sprang up, shut up, and whipped industries out. The stock exchange boomed in Withern and Witherned in Bishby, Arizona, Charleston, South Carolina, Honolulu, Hawaii, Wheeling, West Virginia, and many other forgotten venues. Investors lost real money, but the magic wands of surveyorship waves those losses away. Correction for this data buyer should significantly reduce the early returns of stocks. According to the Bureau of Labor Statistics, logging has an highest incidence of fatal job related injuries of any occupation in US. Almost a century ago, scholars who tried tracking the earliest US stock warned that the cherry-picked indexes might fail to measure a return with the maximum accuracy desirable. Walter Buckingham Smith and Arthur Harrison Chow. The fluctuation in American business, NAS in 1719 to 1860s, and from the start of this 20th century onward, stock market data and indexes like S&P 500 are generally not contained with the surveillance base. Although the performance database of mutual funds as well as hedge funds and other alternative assets from more risky business. History shows that the longer you hang on the stock, the less the rate of return has so varied. Over a longer term, US stocks has gone up the average of roughly 10% annually or for a 7% inflation. Given a devastation year of market 2007 2009 when the US stocks fell more than 55%, their long-term average annual rate of return shrank only slightly from 10.4% to 9.3%. It is a risk in the chance of deviating from the average historical rate of return that has declined if you held stocks for decades. However, after 58% crash, you need 120 to return just as to get back to where you are. You are not going to be thinking, hey, stocks aren't risky. The average rate of return since 1926 has only declined from 10.4 to 9.3%. Instead, you are thinking, if getting more than half my wealth ever centered to in 17 months aren't risky. What's it? As we have seen a looking of cape, it's impossible to certain where stocks are dangerous high. If you buy at what turns out to be peak, the long run might feel like wounds. As Warren Buffett he noted about the investigation long run, people say that stocks have to be better than bonds, but I have pointed out just the opposite. That's all depends on starting price. People who bought the technology heavy in Nasdaq stocks index on early 2000 doesn't break even for more than 15 years. Japanese investors waited more than 3 decades to get back the country's high record stock price in 1989 worldwide. In such market as France, Germany, Switzerland, Taiwan, Thailand stocks have something on negative return after inflation for 20 years or more. Believe that simply extending your holding period or eliminating the risk of stocks is bogus. Time might be our ally, but it also might turns out to be our enemy. A longer horizon gives you more opportunity to recover from the crashes, but it also gives you more opportunity to experience them. You can't erase the risk even if you hold stocks for a century. Investors hate uncertainty. The Paradoxically, all the brings up to a place of hope. One of the Wall Street favorites saying it is investor hate uncertainty. But if you could ever be certain the stock should have high return, they wouldn't even seem risky. And the perceived absence of risk could create more risk than ever. If the stock seems certain to outperform, everyone would buy them. The driving price of high that would have no room left for future growth, making a crash inevitable. That's exactly what happened in 1920 and 1920, 1720 and 1929, 2000, among many other occasions. Stocks are risky. Without any warning, after years of gain, you can lose an ungodly amount of money for an agonizingly long time. But the most suitable risk of owning stock is that you can never be sure what they are overpriced or underpriced, how long it will take for them to return to normal. The only certainty you can derive from the past financial data is that future is always surprising. It and it will most brutally surprise those who are the most certain they know what is about to happen. It is an intellectual, intelligent investor who must accept the stocks are likely but not certain to outperform over long periods. Instead of trying to build a portfolio that would drive you if you would have been happen does happen. Strive to build a portfolio that would try to matter what happens. Stop fruitless trying to predict the unknown. You will exert how many control of accepting how little you can control. This will free your established politics and procedures to structure all the decisions over which you have control.